Namaskar. Welcome to this session of Straight Drive. Last week, we had talked about privatization of trains, and we had a panel of very renowned railwaymen, and they shared their views. Some people told me that although those views were very good, straight from the heart of railwaymen, but we should attempt to talk to people from all the fields, the whole gamut, the spectrum of opinion makers and stakeholders. So friends, today we'll have part 2 of this series of privatization of trains. And I have a panel drawn, rather eclectic, drawn from various fields. Of course, a disclaimer, all three of them in the panel have been a railwayman at some time. We have Professor Manikutty. He was in railway service as a mechanical engineer for 21 years or so. Then he did a doctorate and joined Indian Institute of Management as faculty. And after retirement, he's still a visiting faculty of Indian Institute of Management, as well as Indian Institute of Management, Bangalore and Ahmedabad. We have Mr. A. Venkateshwar. He joined railways as an accounts officer from the Indian Railway Service of Account Service. And after serving railways, he was on deputation as Director of Finance with Singareni Colliery as well as AP Transco. Later, he left railways to join as Executive Vice President of Tata Projects. And since 2014, after retirement, he is an independent consultant mentoring for business ethics, business management, and of course, financial management. We have Mr. Sanjeev Garg, who recently retired as as additional member of Railway Board. He's now the MD of Pipavav Rail Corporation Limited, and he's the Vice Chair of Chartered Institute of Logistics and Transport. He's also a fellow of the Institute of Rail Transport. I'll begin with you, Professor Manikutty. This being the first attempt of privatization of trains on a larger scale, give or take, there have been one or two cases. I will ask for your take on this effort with one caveat that in the approach paper, Indian Railways have themselves said that our major trunk routes are saturated. The saturation would be somewhat relieved after the DFCs, the dedicated freight corridors, are commissioned, but that is some time away, at least for a couple of years. And even if when they are commissioned, the saturation would be taken away from the Delhi-Kolkata and Delhi-Mumbai sectors only. So your opening thoughts as to what you think of this effort to privatize trains, passenger trains, for the first time on Indian Railways.
You know, on the whole, it looks to me that the logic goes something like this. That passenger trains are short, we need much more, considering the waiting lists that are encountered in virtually every major important trains. With the DFC coming, when it comes, then there would be enough surplus capacity in the railway system because many of the important, freight trains would be diverted into that. And that can be used for running more passenger trains. And then why not take the opportunity to let the private sector into the system, enable them to run those new trains, and let them be different trains. There will be good technologies, new technologies, and things like that. And we shall see how it works. Now, there are several assumptions on this whole thing. Number one is, as indeed the DFC is going to come the way we are envisaging and the way we are planning. That I don't know when exactly they will be operational. And secondly, the DFC is going to be in some corridors. They are not really going to be in any major corridors, even in later stages. So at the most, the line capacity is going to be about
Can you hear me, sir?
Yeah, I'm on.
We seem to be having some problem with the picture and audio of Mr. Manikutri.
No, I said, but this should not be the reason because this one side is illuminating.
Back.
Shall we start again?
Please go on, sir.
Or shall we start from where we left off?
Yeah, you start from where you left off, sir. We'll edit it suitably.
Okay. So the assumption is that the DFC is going to be operational very soon, but it is not really going to matter because it isn't going to be in some particular route. So that is not really going to be the justification. It may be a nice thing to see all those new technologically sleek and fast trains zipping along at 160 kilometers per hour. And all of us feeling good, that at last we are somewhere near Europe in some trains and things like that. Frankly, this is the way in which it is planned. Now, there are a couple, before we get on to the economics of it, which Mr. Garg will and Mr. Venkatesh are going to comment upon again, especially Mr. Venkatesh. One has to just keep in mind the experience of British Rail in this respect. What really happened there? British Rail tried to break up their entire British system into a number of operating companies. One of them will be operating there. It will be just a track company. So it will own the track and it will lease out the track to others. Another will be a user company concentrating on passenger trains. Something else will be on freight trains. Something else will be on parcels and things like that. And they would be levied the user charges for them for using those infrastructure facilities which are given by the track company. Now, it was supposed to be a very major innovation, but actually the result was that it was happened quite long ago. The result was an utter disaster. I have not seen any positive comment from anybody about this experiment. The charges went up very substantially and the customer service was atrocious. It is nothing like the complaint service of British Rail. It was far worse. And at the ultimate, if you're really looking at it, what happened was that we replaced a public monopoly by a number of private monopolies because they were not really competing against each other. And as is well known, this is neither here nor there. It is in fact much worse than a public monopoly. The second caveat I want to add at this point before we get on to the cost from Mr. Venkatesh is that there is something called marginal costs, which are very attractive as a very theoretical proposition. And briefly, it will be something like this, that you charge only for the additional costs actually incurred by the leasing company or whatever, the railways in this particular case. And for instance, if somebody is coming and using an additional train, it will be consuming an additional electricity. We charge for that. So long as these costs are easily identifiable, there's no problem. Now, the marginal cost advocates might come out with a justification that you charge them only the marginal costs, in which case essentially it will come to, what are the exact additional expenditures that are incurred and nothing more than that. And you will never really recoup your fixed costs. That is the major danger in really doing that. Now, I have gone through the cost calculation, and there is absolutely no doubt in my mind that they will find it very, very hard to make this whole thing work from an economic point of view. The
Sure.
cost is such that it is going to be very difficult. So I would come back again on these topics, and I would now pass on my turn to maybe Mr. Venkateswar would like to immediately take up on the costs.
Yes, sir. Yes, sir. So I will come to you, Mr. Venkateshwar, now, just at the right time. Now, I'll try to build a simple model for you, a rudimentary model, and ask your comments and modifications. Well, let's say I take a very high-end train of 16 coaches with all AC coaches, maybe a mix of AC2 and AC3, or AC2 and executive class AC chair car, something like that. A 16 coach train which will need a power car, at least one, even if the loco is provided with HOG. You will only be basically be able to use 14 coaches or a little more than 14 coaches because of requirement of pantry and SLR. So, you will spend on one locomotive and these coaches roughly 55 to 60 crores as your capex. And then your expenditure would be on O&M, the service manpower, insurance, overheads, and so on. The revenue based on 1,000-kilometer journey per day. Why I say 1,000 is because our Rajdhani kilometerage is around 1,100 coaches. For Mail Express, it ranges from 800 to 900. So I'm taking 1,000 kilometers as a good base for this. So revenue would be about 10 lakhs. In the previous RFQ document, the haulage charges were, let's call it excess charges, or were placed at around 668 rupees per kilometer. The present document has said to be specified later. So based on this, I find it very difficult for any private investor to really work on a good margin. How would you like to react to this, and how would you like to modify my simple calculations for such that private investors actually show interest?
Yeah. Sure, Sudhanshu. First of all, let me compliment you on the debate you have started on the P word in your straight drive conversations. Privatization during our career was actually a preconceived taboo, and I think this should go. Indian Railways should demonstrate trust and collaboration, which I think it is doing now with this RFQ for privatization of passenger trains. But then before I start, let me confess, I am, unlike many other of my colleagues, I am for privatization, but in a limited way and in the proper way. A major shakeup is necessary because of the reform process. We find that we are yet to get out of our identity crisis. So many years we say we have to operate on commercial lines, and we still have to meet social service obligations. I think this is something which we must now be clear one way or the other. And there is no business without profit, Sudhanshu. I think that's quite clear to many of us. And the reason why we don't find it happening in the railways is because, we have had some legacy principles of accounting. We have had costing issues. We have not been looking very intensely at our customers or our competitors. So this particular model which has been built, I think we should welcome it because it's a first step. And if we were to look at the intent and the content of this concession, which the Indian Railways proposes to give, the intent is very clear. The intent is obviously that we should give better and more efficient service to the customer. And then this should come at almost nil investment to the railways. And that's where the catch lies. Because what you're doing by this intent is actually passing on a whole lot of risks to the concessionaire. And if we were to capture some of these risks, and you have actually put that ballpark figure of, say, 60 crores for a train set, the capex risk. Now, in a model where the revenue generation is based on only a part of an asset, what I mean is the rolling stock would be with the concessionaire, but the train operations, the track would be with the railways. And as we go along, we have to see how exactly this hybrid model of risking the capex when you own only part of the asset will have to be smoothened out. And at the end, you have to see that it's a win-win situation. The next is the OPEX risk. The OPEX risk comes from the fact that while you own the rolling stock, the concessionaire will also have to take care of the repair and maintenance. He bears the fuel cost. He bears what is called the track access charges. Earlier, I believe it was proposed that the haulage charges be with them. But right now, in the latest RFQ, the haulage would obviously be with the concessionaire because he would own the locomotive and incur the expenditure towards the fuel. So track access charges is something we need to get more clarity on. And as you said, we have to service the debt and also this unknown level of penalties, which governments usually are very quick at levying. Penalties for, performance non-delivery. Then you have the traffic risk. Right now, only 5% is being offered of high density routes. Hopefully, the timings of these trains would enable the concessionaire to get a better occupancy and, of course, charge a slightly more competitive rate. It could be lower than what the railways are charging. And then comes in capex, if you go deep dive into the composite structure of the capex, how much would investor like to bring in? How much of debt would he like to bring in? It could be, to start with, it could be a 50-50 mix. And that's where, you have to be very cautious. Or would we go down to lending institutions which could be comfortable with railway operations in India and the demand being what it is of, say, 80-20? So these have to be based on good estimates of the traffic levels. We need to be sure about the interest rates at which this debt will come in, and so on and so forth. So all these risks put together, I think, would actually make the concession extremely tight, as you put it. But then what is interesting is all our estimates are based on data risk. The data which is now currently available in public domain is based on Indian Railways' own historical costing. I think we have to look at the concessionaire or the private player coming in doing his own bottom-up costing. And then comes the bombshell of the concessionaire having to share his revenues, gross revenues, with the Indian Railways. I think this really calls for a lot of introspection as to how do you look at the model helping the concessionaire. Yes.
So,
yeah.
Okay, thanks. So we will talk a bit more about the revenue sharing model, gross revenue sharing or profit sharing and so on a little later. You talked about 5% of the business which is being offered to the private investors. So this is the time I'll go to Mr. Sanjeev Garg. But before that, I liked it when you say that many of your ex-colleagues are opposed to it. Actually, we are all standing in a place where we don't have full information. So it is dislike or like is all based on lack of information. As the Shakespeare has said in Twelfth Night, that it's better to be a witty fool than a foolish wit. So I would like to be the witty fool here today, because it is no good sitting in an entrenched position of wiseness and wisdom when the model is actually not fully understood by you. I would like to ask you, Sanjeev, Mr. Sanjeev Garg, uh, uh, whether this business of clusters is a good idea, and so many of them, and you have to win the entire cluster and not a train. And it's a mix of popular and unpopular routes. Now, the train configuration also is something the concessionaire would not like to change frequently. He would like to have more or less a same configuration. So I doubt if some of these routes can support a fully AC train. So does it distort the business case? And what would you like to have done instead of making these clusters, or would you like to have made the clusters bigger, and so on? Your thoughts on that, Mr. Garg?
Yeah, thank you. Thank you for inviting me to this session today. As far as the cluster-based approach is concerned, I would invite your attention to a similar approach that was adopted by Ministry of Civil Aviation when they allotted the air routes to different private airlines, whereby they gave them the profitable routes along with some routes connecting the tier 2, tier 3 cities, which were obviously non-profitable ones. And you ended up in a situation where only Air India was fulfilling its obligations for the non-profitable routes, while the private airlines were always looking for excuses for not being able to fulfill their obligations towards the non-profitable routes. So I feel that in this cluster-based approach, which has been now adopted for the Indian Railways, the operators may end up behaving similarly. While they would be happy to run their trains on the profitable routes, they would always be looking for excuses to get out of the non-profitable routes. So therefore, obviously, it implies that it may not be a very workable solution in the long run. Moreover, you have fixed that the routes will be totally fixed for the entire concession period of 35 years. Now, in 35 years in any country or in India also, the demand patterns of people for travel can change due to various reasons, either changes in the economy, or how the industrial pattern or agricultural patterns change or behave over time. So we cannot expect that the same kind of demand for travel is going to be constant over the entire concession period. So therefore, we need to provide some space to the operator, that there should be some flexibility. Say after every 10 years, there could be a review or something, so that both the railways and the operators can sit together and work out new ODs, so that you're not stuck to those 35 years concession period. Now, on top of that, you have a problem that, as you very rightly said, that every operator would like to have, whether it is train sets or the normal train composition, the minimum variation in the rakes, so that he can interchangeably use those rakes. Even the Indian Railways have realized over time that it is best to have common composition, because then it helps you in maintaining punctuality. Because if one rake is coming late, you can send another one and start the train right time. So therefore, it is best to have as much standardization in the rakes as possible. But then in the cluster approach, as you also have already pointed out, the profitable routes will have demand for a different type of classes, whereas the non-profitable ones may have demand for different types of classes of coaches. So, but when you are tying the operator down to the cluster approach, he will either be forced to procure different types of rakes to match the different routes, which raises his costs of operation because the capital investment goes up. And if he doesn't do it, then again he has a problem of operating and matching the requirements. So the cluster based approach at this stage, I would say, is not a very wise approach. I would rather say that we have actually taken a very, very high jump right in the beginning. Probably we should go take some baby steps initially, maybe offer certain routes for an initial period of 10 or 15 years, see, and we should learn out of it and then grow, rather than straight away offering a 35-year concession period, cluster based approach, and zero flexibility in the routes. So
yeah, that's a good point that you make, Mr. Garg.
yeah,
I would, yeah, for example, Sikandrabad, Guntur, Sikandrabad, Tirupati, and
yes,
Sikandrabad, Varanasi.
yes,
It will be very difficult to have a common rake for these routes.
exactly.
So, Professor Manikutti, you made your point and you heard Mr. Garg and Mr. Venkateshwar. Now, they have a very ambitious deadline for completing RFQ by September, October, and then RFP stage also quickly, which is also indicative to be a tight one. So we are running against time. It's a first time experiment and we would all like it to succeed. So very briefly, what would be your simple advice to the ministry? Number one. And number two, since there is an avowed objective of also bringing in higher technology, and given that financing the train, existing train itself is going to be a challenge, a train of a higher technology for a small number, there would not be any economy of scale. To bring in a better technology would be a much bigger challenge. So how do you see that, these two things? Professor Manikutti.
Yeah. Basically, these kinds of agreements should concentrate upon everybody being better off. That is to say, it should be a fair deal for everyone. In particular, the private operators must be given a chance to make some money there. And in the process, the railways also should benefit in some sense. It is not just a social kind of a thing we are handing over, which means in turn that its effect on the other operations, including the existing flight operations, whether the charges are adequate, are they fair, these items need to be really looked at. Now, essentially for the calculations, you will find that they will be getting some 35 crores as the revenues, on which the amortization and depreciation costs and the interest on the capital that they invest, wherever it is that amount is going to be there, that will be, if you take it as 20% of that, you will be ending up with at least about 8 crores, 7 crores, 8 crores, that kind of money, which is an absolutely fixed cost in this. Then your haulage costs depends on how you prescribe those haulage costs and what manner. That's why I said the marginal cost is very, very important. At one extreme, you can charge them only for the electricity costs that is consumed by the train and the actual operators costs, that is the drivers and the guards and others. And all the others, you can justify saying that it doesn't really increase any costs of the railways. It is just like a software. If you put in an additional copy of a software, the cost is zero. And therefore, to argue that marginal cost is zero and therefore the price can be zero, that is a fallacious kind of an argument. This kind of a thing will work so long as it is small. That is, indeed, it is in the marginal range. And if you run 100 trains, it is one thing. If you run 300 trains, it is something else. And if you start running 1,000 trains, it is something else altogether. So this must be very carefully understood as to how you are going to do that. And it is not necessary that the formula that you're adopting in the beginning and the later stages must be the same. You can have a more liberal formula in the beginning to attract the people, set them on a good footing, and after once they have proved their viability, to move on to additional charges, which can be built into the agreement, not at a later stage. It should be part of the agreement itself.
Yes.
Then I really do not know if you want to charge everything for the maintenance, tracks and signals and station usage, staff usage, everything. Then why are you after another revenue share there? What is the basic concept of a revenue share? I really do not understand at all.
Yes, sir.
You charge as a percentage of profit, then even that I don't know. I don't know what the justification, but at least some sort
So,
of a justification. But irrespective of whether you're making a profit or not, on the gross revenue you're going to share, and all kinds of things are included in that revenue. And I think
right,
they
sir.
have the model on
So,
the telecom, on this, so that they don't fall into the same trap. So, how much the private sector would be interested in that kind of an arrangement is to be seen. We really do
yes,
not.
sir.
So, at the moment, start with a more liberal approach to attract the private traffic. Forget about this revenue sharing, but build it into that. Over a period of time, this is how we are going to ramp up. And yes, when you are becoming prosperous, let railways also share in that prosperity. It is this sort of an approach which might actually work. So I am also absolutely in agreement with Mr. Venkateshwar that private sector by itself, I have no issue with it at all. And one could see whether it is necessary. Other concerns as to whether this is the best way to increase those capacities, whether Indian Railways themselves cannot procure additional trains, passenger trains, and run them in additional routes. These are options that really need to be considered.
Yes. Thank you, sir. So, what Mr. Garg said perhaps makes sense that instead of going for a whole cluster, we maybe pick up trains. It's easier to then have a same rake. But taking from cue from what you just said, I will like to ask Mr. Venkateshwar that let us assume we're talking of cluster X, where today my present revenue is Y. Even taking revenue is not correct. I would like to say our earning today, profit today from that sector is say Y. If I was able to give this sector to private concessionaire, he will not be able to improve punctuality, he will not be able to bring in technology, but he'll be able to give better onboard services, certainly. And I charge him nearly what is my profit or earning today from that sector. And in the process, if the concessionaire makes earning for himself, we should be okay with this. At least the experiment would succeed. How do you look at this? And number two is we talked of gross revenue. Now, gross revenue has the ticket, the luggage, the parcel. If it's going to be there, I'm not very sure whether parcel is going to be a part of this. And then you have bedroll services, catering services, and advertisement, naming and branding. We want a share in everything. Indian Railways says everything would be shared. So is that a good model, or would we can work out some model where the profit only would be shared in some way? Your two thoughts on these two questions.
Yeah, sure. I think the rail sector is opening up after having seen um, other utility sectors and service sectors having faced similar problems, and taking a leaf from the power sector. I would say that number one, we need to be very cautious, and as my other panelists have already suggested, that we take this one step at a time and learn from experiences elsewhere. To start with, I think in the revenue model, we need to be sure about what are controllable costs and uncontrollable costs. Because in the power sector all over the world, the regulatory body is the one which helps enable the utility to not only survive, but also see that the customer is not dissatisfied. And we need the regulator to be in place here. I'm sure talks are on, and very soon we'll have a parallel activity running on because privatization is now coming to stay. So in the regulatory sector, my experience has been that power sector regulated, financing as well as this helps a lot. IRFC, which we tried for freight trains, has actually taken the capex risk out of the Indian Railways. Why can't we look at that? Why can't we just have a wet lease operation to start with for passenger trains? Because the concessionaire here is going to be saddled, if not for 35 years, if only for 15 years or whatever other periods we are suggesting, he will still be saddled with the capex risk. Whereas for the freight sector, the railways just passed it on to IRFC. Now, could we not attempt that to start with? Let a passenger train be procured by IRFC. It be given on lease to the concessionaire. You give a certain track access, collect the track access charges. See, ultimately, you see, our intent of this seems to be getting lost. Are we sure of the concessionaire delivering services? Because going back into revenue sharing model, in all these PPP projects, the revenue sharing model would actually entail some sort of gold plating. You see, the gold plating happens because you want to actually increase your, decrease your profits. But if you do it at the revenue sharing stage, you will not be able to monitor the performance because you are taking away a whole lot of pre-expensed result. So maybe I would suggest we have a hybrid model. There are cases where you go in for a certain stage where you achieve revenues, and till that time you share profits, and thereafter you start sharing revenues as well. So, and this I'm suggesting because both players, both Indian Railways as well as the concessionaire, this is absolutely new terrain. We have seen the case of the airport PPPs. There, the concessionaire is saddled with a very long period. There are always issues emerging. The regulator steps in, and there the revenue share was done. I'm told in some cases it is as high as 40% of the revenue. Now, this is what I think if we want to make the exercise win-win for both, we must take one step at a time.
Thank you. You talked about the exit in some way. So one uncharitable view I heard is there would be some fly-by-night operators who would start it and use the exit clause within years, and railways would be left holding the bird. That is, they'll sell back the rolling stock to railways. But I'm not going to get into that because I've not even read that exit clause fully. I have two questions for Mr. Garg. One is this oft-repeated phrase, world-class travel experience. I mean, what do you make out of that, number one? And number two, private trains are not new on Indian Railways. In container space, we are running some 20-25% traffic is with basically private trains for a long time. So is there something we can learn from there and to apply in this model, Mr. Garg?
Yeah. I have, in this connection, 3-4 points to make. Firstly, is the question of timing. I think the current timing itself, whereby we have gone in for the so-called privatization of passenger trains, is gone horribly wrong because of the current economic situation in COVID-19. Because, and moreover, as you are very well aware, that only parties with deep pockets can actually come forward because the investment required is a few thousand crores. So nobody with, just a small enterprise can even think of entering this sector. So in a situation where you are going to invest a few thousand crores And when the current economic scenario itself is not particularly good, and in fact is on the downside, it will definitely impact the quality of players who will come and bid for your, the whole thing. So that will affect the whole process, number one. Number two, you've rightly pointed out the issue of container train operators who've been around for the last 15 years. We have about 18 or 19 of these container train operators currently who have taken licenses for running these container trains. Unfortunately, out of these 18, 19, only 3 or 4 of them can be said to be managing to remain afloat and making some amount of profit. The rest are either making losses or have more or less closed shop. So that itself is an indication as to the success of the whole scheme. Because if a majority of your container train operators have either shut shop or are unable to remain afloat or are running in losses, that means the scheme itself is obviously flawed. Because any such scheme should bring about certain minimum profits to the operator. And you have another example with the special purpose vehicles, which were set up by the Indian Railways in the last 20 years for implementing project specific railway lines, whereby equity was brought in by private players along with the Ministry of Railways. PRCL is one of those SPVs. But we have examples like Krishnapatnam Railway Corporation, which has basically become a non-performing asset because South Central Railway has refused to share the revenue it was supposed to share with them. I mean, that's a very strange case that traffic is running on the new line and South Central Railway is not apportioning the correct revenue, and it has become a non-performing asset. Now, you also have, what I would say that the railway is not only the infrastructure provider, it is not only setting the rules of the game, it is also acting as the arbitrator or the regulator. World over, the regulator has to be independent. And our own experience in these SPVs also, we are finding that because we have to deal with the Ministry of Railways and the zonal railways, where they are our shareholders, partners, and infrastructure providers, and also the acting the role of regulator. There is a conflict of interest involved, and that creates problems for the private operator or the SPV. So that problem will be there even for the private train operators, because there will be no regulator around to look at things independently and dispassionately. And another very important thing is that ultimately the railway, whatever model you adopt, whether it's the haulage charge model or the revenue sharing model or track access charge, whatever, the railway wants to recover its costs which is incurring. Unfortunately, the Indian Railways over the years has become a high cost organization, as we are all aware. 60% of our expenditure is on staff costs. And those staff costs, I mean, of about 1.3 million staff, 95% are in group C and D. And we are paying them, CTC, cost to company expenditure, is 2 to 3 times what the market cost is. So we are actually paying them much more than what the market is valuing them. So that itself is making us a very high cost organization, and therefore it makes us uncompetitive. And that
Thank
is
you,
one of,
Mr.
yeah.
Yeah, good. Thank you, Mr. Garg. So basically, friends, we wanted this debate not to be centered on right versus wrong, but predicated on right versus right. I mean, there are genuine dilemmas, and each truth, if I may say so, is rooted in some core value or some core thinking. Before we close, with a view to make this experiment successful, I would request all the panelists to give their thought in 1 minute each, a closing thought. Professor Manikutty.
Ultimately, this has come because of the inability of the Indian Railways to provide adequate passenger service, both at a good level of quality as well as in adequate numbers. So it cannot really run away from that responsibility, even if this experiment proves successful. Let the privateers or private operators be there, but the railways will still need to figure out how we are going to provide adequate passenger trains and not the same kind of passenger trains which were there like 60 years ago. Some absolutely new technologies like TV-18 trains and different kinds of trains, and fulfill their basic responsibility, provide adequate transportation. So if this is not lost sight of, privatization and running these trains may not be that much of a hard, difficult problem to crack.
Thank you, sir. Mr. Venkateshwar.
Yes. Couple of suggestions on the document of the railways. I think concessionaires must be allowed to negotiate on either access charges payment or a very small share in the revenue. You can't have both. That is number one. Number two is that the concession period should have two stages. One in which it's almost a trial run, trying to understand the model. There should be a review mechanism. There should be two parts to the whole deal. Penalties could make or break this concession, because right now we have absolutely no idea as to how the performance levels expected would be determined by the railway's own performance, say for instance on platform management, rate management, and punctuality, and so on. So we need a good measurement and monitoring system for this performance. We should have a third party to do the checks on this. We should not be the, as somebody said, we should not be the auditors in this case. And finally, an independent regulator is a must. And we need to learn lessons from other sectors, whether it's the air sector, airline sector, or the power sector, or so on and so forth.
Thank you. Mr. Garg.
Yeah. My point is simply that certainly privatization is a good idea, and we need to go in for it, but in a manner that it is implementable and it is successful. Because if your first experiment itself somehow gets flawed and is not successful, it will therefore kill the whole idea of privatization, which otherwise is a very good idea. So, and we must remember that even today in the passenger sector, Indian Railways is able to recover only 55 paisa out of 100 paisa it's spending per passenger kilometer. And the private operator would be expected to recover at least 115 paisa out of the 100 paisa he would be spending. So so you can see the difference in the recovery rate between the Indian Railways and the private operator. And that is what is going to make things difficult in the current way the whole privatization process is structured. And therefore, I feel that it may not, the whole process may not be successful, which may kill the whole idea of privatization. Thank you.
Thank you. So, thank you, Professor Manikutty, Mr. Venkateshwar, Mr. Garg, for taking out time and for a very meaningful discussion here today. Thank you very much.
Thank you.
Thank you.
हजारों ख्वाहिशें ऐसी कि हर ख्वाहिश पे दम निकले, बहुत निकले मेरे अरमा फिर भी कम निकले. ख्वाहिशें यानी wish list, both Indian Railways and the would-be concessionaires have a big wish list. Some would be met, some would not be met, and all cannot be met. We have to move forward in a situation which can be made a win-win for both. And let's hope for that. We will be back soon because this is a discussion which has evoked very good response. Thank you very much. Namaskar.
Thank you very much. Thank you, Sudhanshu.